Understand the purposes and uses of the main financial statements. The balance sheet shows the financial position of a business at a specific date by listing assets, liabilities, and equity. It is based on the accounting equation and shows what the company owns and how those resources are financed. Users analyze the balance sheet to evaluate liquidity, solvency, and financial flexibility. For example, comparing current assets to current liabilities helps determine whether the company can meet short-term obligations. The balance sheet is important because it provides a snapshot of the company's resources and obligations, which helps users assess risk and stability. The income statement reports the results of operations over a period of time by showing revenues, expenses, and profit or loss. It explains how equity changed as a result of business activities during the period. Users examine the income statement to evaluate profitability, efficiency, and performance trends. For example, increasing revenues and controlled expenses usually indicate good performance. Because the income statement covers a period rather than a single date, it helps users understand how well the company generated earnings from its operations. This information is important for investors, managers, and creditors. The statement of changes in equity shows how the owner's interest in the business changed during the accounting period. It includes contributions from owners, dividends, profit or loss, and other adjustments that affect equity. This statement explains the link between the income statement and the balance sheet by showing how retained earnings changed during the period. Users review this statement to understand how much profit was kept in the business and how much was distributed to owners. It helps evaluate how the company finances growth and how profits are used. The statement of cash flows reports cash inflows and outflows during the period and classifies them into operating, investing, and financing activities. This statement helps users evaluate liquidity and the company's ability to generate cash. A business may report profit but still have cash shortages, so the cash flow statement provides additional insight that the income statement cannot show. Investors and creditors use this statement to assess whether the company can pay debts, invest in new assets, and distribute dividends. Together with the other statements, it gives a complete picture of financial performance and position. Identify the major components and classifications of each financial statement. The balance sheet is divided into three main components: assets, liabilities, and equity. Assets are usually classified as current or non-current depending on how quickly they are expected to be used or converted to cash. Current assets include cash, accounts receivable, and inventory, while non-current assets include property, equipment, and long-term investments. Liabilities are also classified as current or long-term, depending on when they must be paid. Equity includes contributed capital and retained earnings. These classifications help users evaluate liquidity, solvency, and financial structure by showing how resources are invested and how obligations are financed. The income statement reports revenues, expenses, and profit or loss for a period. Revenues represent income earned from normal business operations, while expenses represent the costs incurred to generate that revenue. Expenses may include cost of goods sold, operating expenses, interest, and taxes. The difference between revenues and expenses is net income or net loss. Some income statements present subtotals such as gross profit and operating income to provide more detail about performance. These classifications help users understand how profit was generated and evaluate efficiency, cost control, and overall profitability. The statement of changes in equity shows the components that cause equity to increase or decrease during the period. Major items include owner contributions, dividends, net income, and other adjustments. Retained earnings is usually the largest component and changes each period based on profit or loss and distributions to owners. This statement explains how the ending equity balance in the balance sheet was determined. By separating the different sources of change, users can see whether growth comes from profits, new investment, or other factors, which helps evaluate the company's financing and performance. The statement of cash flows is divided into three classifications: operating, investing, and financing activities. Operating activities include cash flows from normal business operations, such as cash received from customers and cash paid to suppliers. Investing activities include buying or selling long-term assets, while financing activities include borrowing money, repaying debt, issuing shares, or paying dividends. These classifications help users understand how cash is generated and used. Because cash flow is essential for survival, this statement provides important information about liquidity and the company's ability to fund operations and growth.